Hello, this is Ernest Burley, your CIA, your cool insurance agent, back at you again with some more great information on insurance. Once again, I am licensed. I'm a licensed insurance agent across many states in the country. I have clients all over the country also, and I have over 30 years of experience in the insurance industry. My firm I specialize in all areas of insurance. So from auto insurance to homeowners insurance, life insurance, disability, long-term care, business, commercial, church, what have you, we specialize in it. And the goal here for this podcast is to make sure that you have clear, unbiased, objective information. Okay. So the goal is to educate you, to enlighten you, empower you, so you can make the right decisions for yourself and for your family. Okay. So that's what this is all about. I would love for all of you to be my client. I know that's not possible, but hey, if I can help you, give me a call. But I just want you to have all the great information so you can make the right decisions wherever you are. Okay, so that's my intro. I don't like long intros. I want to just get right at it. So the podcast for today is called TMI. TMI. I think I am giving y'all too much information. So I'm giving y'all all the inside scoop on the insurance industry, but that's what I'm here for, to make sure that I'm taking care of you and making sure you have the right information. So I don't mean TMI in reference to too much information. TMI, I'm taking a different spin on it. TMI is tax mitigating insurance. So I'm going to show you how to save some money today by having certain insurance policies. TMI, tax mitigating insurance. So our first TMI is the cash value in a life insurance policy. That's TMI because the tax deferred growth in a cash value life insurance policy helps you save money on taxes, right? So if you make $1,000 in the cash value in the policy, say the policy goes up by $1,000 this year, you don't have to pay taxes on that money. It just rolls over to the next year, and every year it just goes up and up and up. That's tax deferred growth. That's TMI. So the cash value in certain life insurance policies is TMI for you, is tax mitigating insurance. Also, if you take a loan against the cash value in a policy, say you have a whole life policy, you take a $10,000 loan from the policy, you don't have to pay taxes on that, okay? That's more TMI. Now, if that policy lapses or you surrender the policy, then of course, yeah, that becomes taxable income to you plus interest, okay? But that's our first TMI, the cash value in certain life insurance policies, because that cash value goes tax deferred going forward. Our next TMI is the death benefit on a life insurance policy. You don't pay taxes on a death benefit in a life insurance policy because life insurance is considered replacing a loss. So we know you can't really replace a loved one, but that's what life insurance is trying to do, replacing a loss. So it's considering you not to be in a better position because of that loss. It's putting you right back to where you were before. Now, we know that's not the case because of emotional situations or whatever. You can't replace a person or a life, but the tax consequence there is that there are zero taxes as a consequence because it's just replacing what you have lost as opposed to putting you in a supposedly a better position. So that's TMI. The benefit, the death benefit on a life insurance policy. So if you're the beneficiary, and I'm going to have a podcast on the different parties to a life insurance contract, because that is very important to know. If you're a beneficiary, you receive a benefit, no tax benefit, no tax repercussions to you, TMI. Now, if that policy has a cash value to it, then yes, you're going to have to pay taxes on that. There's going to be a tax consequence there because that's a cash value. That's in addition to the death benefit on the policy. The face value or the death benefit of the policy, no tax repercussions there, no situation there, but on the cash value, yes. Our next TMI is HSAs. Have you heard of an HSA? Stands for Health Savings Account. And these plans are great. It allows you to put away money pre-tax into an account, okay? And that money grows tax deferred going forward, and you can use those monies for money for qualified medical expenses, basically. So they're only available for high deductible health insurance plans, though. So you have to have a high deductible to qualify for the plan, but an HSA is a great plan to put away money to save over time. If you don't have to tap the money throughout the year, it just grows from year to year. It comes out pre-tax, so it lowers your taxable income, and it grows tax deferred, so you don't have to pay taxes on it going forward. Now, once you reach age 65, you can also continue to use the money tax-free when you pull the money out. you use it tax-free. You don't have to pay taxes on it as long as it's used for qualified medical expenses. You can continue to do that at age 65. But if you choose to pull the money out for some other purpose, you just pay taxes on the money. Now you got to grow it tax deferred, right? You pay taxes on it and you can use the money for whatever you want to use it for. So it's a great way to supplement your retirement income also. Now, if you pull the money out before age 65 and use it for something other than qualified medical expenses, then you're going to owe taxes on the money and a 20% penalty. So let's not do that. Don't do that, okay? If you're going to use it before age 65, use it for qualified medical expenses so you have no tax repercussions. At age 65 or older, you can use it for whatever you want, but you will have to pay taxes on it if you don't use it for qualified medical expenses. That's more TMI. That's a great TMI right there. Tax mitigating insurance. Another TMI, FSAs. A lot of people are familiar with FSAs, flexible spending accounts. That allows you to take out money pre-tax, lowers your taxable income, right? That's a great thing. And use those monies for, certain health expenses, health expenses. Now, the thing with this plan is there is no float from year to year. It doesn't roll over from year to year. This is a use it or lose it proposition. So you need to use that money by the end of the year or you will lose it. Let's not do that. Let's not give money back to the company that we're working for. The FSA, if you have money at that FSA towards the end of the year, you get you some designer glasses or something that qualifies. So you make sure you use all of the money there. So you do a guesstimate and figure out how much you're going to spend for medical expenses, co-pays, things of that nature throughout the year. That money comes out pre-tax that saves you money, TMI, tax mitigating insurance, and you use it throughout the year, but don't leave anything in there because if you don't use it, you lose it. Okay. Next TMI, long-term care premiums may be deductible. So, wow, we're getting into a lot of TMI here, right? So if you have long-term care insurance and you reach 7.5% of your adjusted gross income and medical expenses, you can deduct your long-term care premiums up to a certain amount. That's a sweet deal. So let's give you an example. Say, for instance, your income is $50,000 a year. 7.5% of $50,000 is $3,750. So if you reach that $3,750 in medical expenses, you're able to deduct your long-term care premium expenses up to a certain amount. The older you are, the more you can deduct. The younger you are, the less you can deduct. So like if you're in your 40s, I think the deduction may be like around $800 or $900. But if you're like 51 to 60, the deduction is somewhere around $1,600 to $1,700. And if you're 71 or older, you can deduct like over $5,600 of your long-term care premiums after you've reached 7.5% of your adjusted gross income and medical expenses. More TMI, more tax mitigating insurance. Let's make sure we're speaking to our accountants about this stuff, okay? Our next TMI is the long-term care partnership program. So this program allows you to keep more of your assets. Like say if you need long-term care services, and I'm going to do a podcast on long-term care also. Long-term care, LTC is TLC, tender loving care. So you need to have some long-term care protection because it's a big hole I see in a lot of people's insurance portfolio, okay? But we'll have a podcast on that and talk more about it. But the long-term care partnership, what it does is it allows people to keep more of their assets as opposed to having to spend down for Medicaid. So if you qualify for Medicaid, in order to qualify for Medicaid, you have to spend down and have no more than $2,000 in assets in your name, right? Now, if you have a long-term care policy and you exhausted the limits in that policy, they allow you to keep that much more in assets. TMI, people, TMI. So here's an example. Say you had a long-term care policy with $100,000 benefit and you ended up having to use those services and you exhausted that policy and now you're eligible for Medicaid and you're transitioning on to Medicaid. Medicaid would allow you to keep $100,000 of your assets plus the $2,000 normal spend down limit. So you can keep $102,000 of your assets as opposed to spending down to $2,000 because you had that long-term care policy that you exhausted to help out Medicaid, right? That's some great TMI. That is some great TMI, okay? So that's it for that TMI. Our next TMI, okay, here we go. Employers. The insurance that you have, the benefits that you have through your company. So health insurance, disability insurance, life insurance, long-term care, any insurance plans that you offer as health benefits to your employees, that's TMI, that's tax mitigating insurance. You can write that off, right? Also, employers have TMI with policies that they have to protect their business for the property damage they may sustain or liability. So general versus professional liability. We talked about that in another podcast, right? Check out my podcast called Mind Your Business. where I talked about different types of insurance in general versus professional liability was one of those situations that I discussed. They're two totally different types of policies. Workers' compensation, that's another type of insurance policy that employers have. Auto insurance for the business vehicles, that's another type of insurance. Commercial liability umbrella policies, those are more types of insurance plans that are designed to help the business and protect the business. So that's TMI, tax mitigating insurance. It's reducing the taxable income by having those types of plans in place. Next, TMI, real estate investors. I don't care if you have one house or several properties or apartment buildings or what have you, you better have some insurance on those properties to protect the property itself, of course, right? So if a fire happens, windstorm, or tree falls in the house, whatever happens to the property, you want that property insured, right? And you also want to make sure any liability arising out of the property that may extend to you is going to be covered. So the TMI there is tax mitigating insurance to protect your assets there as a realtor, as a real estate investor. And I forgot, I went a little bit fast on the TMI for the long-term care partnership. The way that is TMI is because you don't have to sell off assets. You won't have to sell off the $100,000 in assets and pay taxes on those assets. So that's TMI. That's the TMI for long-term care partnership. I'm trying to just get through this information so I can get you on your way, okay? But that is it for the long-term care and the other assets that I have here that I've listed for TMI, helping you protect your assets or to protect you against having to pay insurance or taxes in some situations, okay? That's it. Let's recap it. So the recap is we've gone across various areas of insurance. We've talked about life insurance as a TMI, health insurance as a TMI with the FSAs and the HSAs, right? The flexible spending account, the health savings account, the life insurance with the cash value, build up tax deferred savings there, the business policies, that's commercial insurance, real estate investors. So we've gone across various areas of insurance that end up being TMI, not too much information, but tax mitigating insurance. Now, our takeaway is that TMI is your pal, right? Tax mitigating insurance is your PAL, two acronyms. TMI is your PAL. And PAL stands for what? Protects assets and lifestyle. So TMI, tax mitigating insurance, protects your assets, right? It protects, so you don't have to pay taxes in some of those situations. Some situations it's tax deferred, which allows you to grow your money. In some situations, you end up not having to pay taxes at all. So the TMI protects your assets and your lifestyle. TMI is your PAL, your pal for sure. Okay. Thank you. Thank you so much for listening to my podcast. That is it for today. Please share this podcast with your friends and have them share with friends. Let's do some viral podcasting here. Right? You tell two friends and so on and so on and so on. So I appreciate you guys listening. I really do appreciate it. Hopefully you got some golden nuggets of information about this TMI situation and that TMI is your PAL, tax mitigating insurance is your PAL. If you want to connect with me or reach out to me, ernestburleyjr@gmail.com. That's the easiest way. Just my full name at Gmail. That's the easiest way to contact me. Or my firm. The phone number is 301-262-2600. Again, that's 301-262-2600. Hey, I'm signing off. Your CIA, your cool insurance agent is signing off. Ernest Burley Jr. Until we speak again, take care of yourself and have fun out there.